Should I try owner financing deals for real estate investing? Let's talk about what this is. What is owner financing deals? Well, let's say there's a house, and let's say Bill and Sally own the house. Okay. Let's say that Bill and Sally are interested in selling the house, but they're willing to finance it. And what that basically means is they become the bank. A lot of scenarios here. I'm not going to get into all the details on all these strategies, but I'm going to talk about the one that I think makes the most sense to you. So most of the time, if somebody owns their house free and clear, they don't have any loans on it. Let's say that you were going to buy this for $250,000. They didn't owe any money on it. Most of the time, Bill and Sally are not going to do that without a huge down payment. 20, 40, 50, 70, whatever the case is. They're going to want a lot of money because their only security is if they sell to you and you give them 50,000 and they create a note, which is an IOU for 200,000. It's attached to the property and it may be at an interest rate of 5% or 8% or 9%. And then you're making payments to these guys every single month. That's how that's kind of working out. Those deals are typically more difficult to come by and typically use quite a bit of cash. And for most people we're working with, they're trying to get in with as little cash as possible. So another strategy that is used is called an all-inclusive trust deed. And that means that Bill and Sally have a loan on their property. So this is Bill and Sally. Let's say they owe $100,000 to Chase Bank. We'll just pick on them for a minute, okay? And you want to buy this for $250,000. Actually, let's say they owe Chase Bank $200,000. And they want $250,000 for their property, but that's more than what you'd really like to pay. Well, maybe they have a really good interest rate, like a 3% interest rate. So what you can do is you can do an all-inclusive trust deed. And that means you owe Bill and Sally $200,000 and Bill and Sally owe Chase Bank $200,000. If you're doing something like that, you typically are going to want to go through an escrow company to make sure the taxes, the insurance, and the bank is actually getting paid. So you would pay the escrow company. The escrow company would then pay Chase Bank. And if there's anything left over, depending on how the deal is structured, that would then go to Bill and Sally. This can be a good tool as well. However, I think the best way for you to utilize things is what's called an unsecured note that's seller financed, because this is the most typical scenario that I run into that can really help. So let's talk about that. Okay, so you went and found a good deal. You're negotiating, whether it's on market, off market, whatever the case is. And again, it's going to be Bill and Sally. Okay, Bill and Sally. Okay. And we'll just keep this, we'll kind of keep our numbers straight here as well. It's 250,000 is what they want for the property. You go in, you do your inspections, you find out the repairs were going to be 70,000, but they're now going to be $80,000. Your loan comes in and you're only able to get, say, 240,000. Okay. So there's a $20,000 difference here for the rehab. There's 10,000. The hard money lender's like, hey, the values aren't quite what you were thinking. So there's a gap here of 10,000. He says, hey, I'll fund 240, and says, great. But that 240 was based upon a $70,000 rehab budget, and the rehab budget is now 80,000. So you need another $10,000. So you're $20,000 short of making this deal happen. Okay. Now you were planning on coming in with $10,000. So that helps, but now you're $10,000 short. Okay. So there's a few things you can do here. You can go back to Bill and Sally and say, Bill and Sally, I can't buy the house for $250. I found out some of these problems. I'll pay you $240. That would put it in line. You'd be coming up with a $10,000. If they're okay with that, great. What I typically see, people will do that. But sometimes they'll be like, I need the full 250. I'm not going to do it. Those types of things. So number one is just asking them the lower price. If they're not willing to lower the price, the next step that we're going to do is we're going to say, hey, I'll tell you what, I'm going to give you 240,000 now. as part of the loan when I buy the property, and I'm going to do $10,000 as a note. Okay, this is going to be an unsecured note, meaning it's not going to be attached to the property, but a credit card, a payday loan, those types of things are unsecured notes as well, which is basically I owe you. And so I owe you $10,000 to Bill and Sally, but that is not attached to the property itself. It's attached to me owing it to Bill and Sally that I owe them that money. And so what I'll typically say is, hey, Bill and Sally, I can get you the 240. I can get you the 250, but I can get you 240 now, and I can get you $10,000 when I sell the property. So maybe this is a fix and flip and say, hey, give me a year. I'll give you the $10,000 in a year. I have to pay off the lender. What's left goes to you, and then I make any profit above that, and we'll send that to you in 6 months, a year, whatever the case is. Or if you're turning this into, you could do monthly payments to them if that makes it easier, but I try and not make monthly payments. I'm trying to say, hey, just in the future, I owe you and I'll pay you the $10,000. Now, most of the time you can get away without paying any interest to them because they're getting the higher price on the property. And you may have to negotiate some interest rate that would accrue. So it's like, hey, it's $10,000, but I'll pay you $11,000 in 12 months. And then you sign what's called a note or a promissory note that says, I promise to pay Bill and Sally that amount. And then you close, Bill and Sally get the 240, rehab the property, resell it, send them the $10,000 or $11,000 if you had to negotiate interest. And that is called an unsecured note or a seller financing. The seller is financing a portion of the purchase. The majority is coming from that hard money loan. And the reason that they're willing to do this is they're going to get most of their money now, a tiny bit later, but it makes the whole deal actually be able to happen. So that's what I look at when we're talking about seller financing and putting deals together. It's that little, I call it the gap. If there's some money in between what you can get from your hard money lender for the purchase, the rehab, the closing costs, the payments, and how much the seller really needs to get, as we have a gap there. One of the ways we can solve that gap is to renegotiate with the seller. The second way we can solve that gap is to do an unsecuritized promissory note. So we say, hey, we'll do a promissory note, I owe you, I'll pay this amount at a defined period of time.